G'day everybody, welcome to the weekly general update for the 21st and 22nd of April. And markets are a bit stuck at the moment. There hasn't been a lot of movement in the S&P index in the States for something like 8 to 10 sessions now. The Australian market is showing a little bit more than it has done over the last 3 to 6 months, but nevertheless there's not a lot of movement in stock markets, in commodity markets, currencies or bonds. It's really a fairly quiet period. But anyway, we'll have a look at the action. So first of all, just a reminder that this is general advice only, and you certainly need to weigh up any decisions that you make against your own personal circumstances. So a summary of the action for the week. The S&P ended up rising just 8 points, and it was a fairly quiet week all round. Now, as you know, I've been calling this as a typical ABC correction to the downside, albeit a fairly mild one, because that's how crowd behaviour plays out. It could well be that this ABC correction might be getting cut a bit short on the C leg. We've certainly had the A leg down and the B leg back up again, and we're still really in a bit of a question mark as to where exactly we sit at the moment. But we'll look at that on the chart in just a moment. But I would say that the longer this sideways movement does persist, the more likely it is that we've already seen the low, which was at 1358. I'm still of the view that we've still got another leg higher, and that we're still looking at 1440 as being the target after this corrective phase completes. So it's really the question mark is, what is the nature of this completion of this corrective phase? 1320 to 1340 still possible to the downside, but we'll just have to see how it plays out. The ASX index, by comparison, had a better week, rose 44 points with some strength in both the banks and BHP and Rio towards the end of the week, so that was a nice change to see our market outperforming. And we had a false break of the 43.50 resistance about a week and a half ago. We pulled back into the range, which was a pretty bad sign, and then we've immediately gone back up and now closed above 43.50, so we've now confirmed the breakout. So this really is quite unusual price action at the moment. And as I said, the banks and the resources did make some headway for a change. There's still a few small caps moving. The liquidity and trading volumes have come out of the small caps over the last couple of weeks. I don't know whether that's a temporary thing or whether it's going to be sustained for a longer period. In other words, is this the end of the momentum that we've seen in the small caps for this year? There's certainly still a few small caps moving, so there's still gains to be made in very stock specific opportunities, but basically the across the board high liquidity that we've seen this year certainly has dried up considerably. So let's just have a look at a few charts. We'll start first of all with the S&P, and as you can see here, I was expecting to see an A leg down, which we got, which completed on the 10th of April. We then get a bounce, which we've had, albeit not a particularly strong one, and I then would have expected the market to complete a C leg to the downside with support at 1340 or 1320. But you can see that we've now had about 4 or 5 days where it's just effectively gone sideways. So that does open up the possibility now that that we have seen the lows, and that we'll just muck around here for another few weeks, maybe dribble a little bit lower and then head higher in a final challenge into May of that 1440 high. At this point in time, I don't really know what the market's going to do. It doesn't really matter. I believe that any downside that we are going to see from here is probably going to be fairly mild. Typically in these corrective phases, the most significant down days occur early on, and then the market quietens down. So it's a bit like a bit like a rubber band, twanging a rubber band. You get the biggest amount of movement when you first do it, and then it gradually settles down. So that's how I see the S&P. I think we've probably got another week or maybe 2 weeks of this kind of fairly non-volatile action, and then I think we'll probably get a break to the upside. By comparison, the ASX, as you can see, we got a false break of this 43.50 resistance, which had been tested 9 or 10 times. We got a false break on the 2nd of April, then closed back into the range. We then got 5 or 6 days down, and now we've moved back out again. And as you can see, Wednesday, Thursday, Friday of last week were all quite positive, although the ranges of the days are shortening up quite quickly, and we still haven't really broken the high of the 2nd of April yet. So I'm not getting too carried away with the Australian market at this point in time. Let's just have a look at the US dollar index, because currencies are important. You can see the movement here in the US dollar index is also getting less and less. The ranges are getting smaller. It's generally just tightening into a really tight funnel, and ultimately, because high volatility does follow low volatility, we will get a breakout. At this point in time, I really don't have a view as to which way that might be, because it all depends so much on what's happening in Europe. If fears were really to escalate over Europe again, then you would see the euro go down and the US dollar go up. So I'm pretty neutral on where that's going, but I think we are probably heading towards a more significant move in the not too distant future. 30-year bond yields, as you can see, we started to get a breakout back in mid-March. It hasn't come all the way back down to its lows, but certainly that expectation of higher inflation seems to have died away again. So we'll just have to wait some more on that one. Okay, let's have a look at just a couple of comments on Europe. They had some bond auctions in Spain, and that's really where all the attention is at the moment. It's moved away from Greece and now very focused on Spain. They had some short-term bond auctions, 2-year and 3-year bonds that were disappointing. I believe they had a 10-year, a critical 10-year bond yield, which they were able to get away, but not particularly easily. But they're still, interest rates there are still under 6%, but certainly not looking good in Europe. And also Italy's not out of the woods yet. They're just sort of off the front page at the moment. So there's still plenty of potential problems in Europe, but I think the market expectation is that the ECB will step up and provide whatever liquidity is needed. However, offsetting that, Germany is going like an absolute train at the moment, and the economic data coming out of Germany really is very impressive, and it's better than what most commentators are acknowledging. So it's not all bad in Europe. As I mentioned, Spanish and Italian bond yields, they've stabilised, but it's really only because of the ECB, and we saw the US 30-year yields as well. So looking at gold, gold was down $15 on the week, and it's still consolidating around the bottom of the triangle. I'm still of the view that the overwhelming odds favour the fact that gold has bottomed and that it is in the process of heading higher, albeit a bit slowly. We need to see it break above 1690 to signal the next wave up, so that's a key level to watch. We're currently about 1642. And the US-based gold miners indices, the GDX and the GDXJ for the juniors, they showed a little bit of upside early in the week, but then they lost momentum again, and these gold stocks really are frustrating, but there will be a point where the gold market will take off. So if you've got gold exposure, we just need to sit and wait patiently. If you've got good quality gold exposure, I don't think you've got any concerns at all. If you own some of the developers and explorers in the early stages, then that's a completely different issue altogether. and I would be extremely wary about holding non-producing gold stocks once we get past May and into June, because that's a weaker time of the year, and it also tends to be a bit seasonally weaker for gold as well. So I would be incredibly cautious about gold explorers. Oil was down just a little bit on the week, but not very much, and copper rose to $3.70. So we did get a break of an important support level on copper. Dropped from 380 to 360 the week before last. Has started to work its way back up again as fears about China are easing off. Here's the 6-month price chart on copper. You can see that we had been holding a range there between about 370 and about 390. We did get a drop out of that under that support, but it's come back up to test the support now. So the next week or two will be important for copper. Let's just have a look at the gold chart. So we'll look at gold first of all on a weekly, and this hasn't changed very much in the last month. As you can see, we're forming up this triangle that's getting tighter and tighter. I believe the breakout will be to the upside. It's still holding this long-term trend line that was been established since the end of the GFC. So it's just gold is just taking longer than what we would have expected. But when you're living with it day by day, it's quite easy to get impatient. If you just step back and look at the big picture, gold has gone up every year for the last 11 years and is not really showing any signs of doing anything else. We got a deviation to the upside, which was massive, the biggest deviation away from the moving averages that we'd seen since the whole gold bull run started. So the fact that we're getting now a consolidation that started in September, so we're now talking nearly 8 months, is not at all unusual, because we had a run up that lasted 34 months. So to consolidate and go sideways for 8, just put it in that context. I don't think there's any issues with this at all. Just looking at the dailies, you could see really last week there was very little movement, small ranges, and not really going anywhere to my mind, but certainly seems like it's formed a base. I'll just have a look at the GDX and GDXJ charts. So this is in on a daily. I still believe we're close to the bottom, but we did get a bit of a turn up on the 12th of April. I thought that may signal the start of a move up, but not quite there at this stage, and the GDXJ looks pretty similar. So just a final few thoughts, and this is the same slide that I put up last week, just for those who are new to this weekly update, and I guess just as a reminder on perspective, I track the S&P index because it really does set sentiment for global markets. Even though you may not be trading the S&P index, I think it's always worthwhile to take your cues from what that index is doing. Now, with respect to Aussie stocks, we still are a bit weak at the index level. I'm not convinced that we're heading back into a trend up. So at the very best, I think you should be looking at trading the ranges on the larger cap stocks, because I don't think they're really going to do too much. And in terms of overall exposure, I believe you absolutely should hold some cash. There'll be some good buying opportunities, particularly when we get into the middle part of the year, because that's seasonally weak and there's always generally some good opportunities. I would certainly be shifting your balance to better quality stocks. I wouldn't have a whole portfolio full of really speculative stocks, because they're the ones that can drop 10, 20, 30% in a day if there's a sudden move overseas. There's still some gas stocks offering some great opportunities, and but entry and exit techniques are just really so critical these days. So that's it for this weekend's update. We'll see what the next week brings. I suspect it probably won't be a lot different at this stage, and this very much remains a specific stock pickers market. So that's it for this weekend. Cheers.
If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.